Hello everyone. Thank you for joining me here today. I'm Rong, Phillip Research Analyst, and today I'll be just sharing with you some of the key themes for the US market moving forward in 2021. So I will start with a brief recap of year 2020, which we all know is known as the year of everything rally, right? So with the influx of money supply and also the low interest rate environment, there have actually been a frenzied buying across all asset classes, from equities to gold, oil, and yesterday we saw even Bitcoin. In terms of ETF net flow for year 2020, we have seen very strong net inflows in both equities and also fixed income. Okay, but for the last 3 months of 2020, there has been greater risk-on sentiments with all this vaccine optimism and also a greater clarity over the US election and also a fiscal stimulus. So we can see this by the proportion of net inflows between equities and fixed income, where equities account for actually 2/3 of the overall 3-month net inflow. So we actually end the year quite strongly in terms of risk-on sentiments. So the question on everyone's mind now will be whether there is still room for further upside this year, especially with all three US indices, hitting all-time high in 2020. So my short answer to you will be yes, and I will tell you why. Firstly, okay, if you look at the State Street Investor Confidence Index, so this is actually a measure of a global risk appetite for investors. It actually shows that in terms of a recovery, there may be further room for more risk-on sentiments. So with risk-on sentiments, you'll drive capital more towards equities. And with the recovery from the previous global financial crisis as a gauge, we see this index actually hit a peak of 127 in terms of reading. And this is as of a year end, the reading is at 104. So there is still some room for upward movement in terms of investors' risk appetite. So if we break it down into the different regions between North America and Europe, we can see that there's actually a higher divergence in Europe. A main reason is because current risk-on sentiments are still weak in Europe, especially with this extension of COVID lockdown. But if you have a longer investment horizon, actually the subsequent global economic recovery should lead to a stronger rebound for Europe. But not to forget, from the chart on the left, there is actually still room for upside in the North American region, okay, which of course will include the US itself. So secondly is that in terms of additional stimulus relief, actually we have seen a boost in personal income for the population. And despite having a fall in the US savings rate from its April's peak, we can still see that the saving rate still remains quite elevated. So currently it is at 13.6%, which is higher than the 5-year average of around 7.4%. Which suggests that there is further room for unlocking of capital itself. And looking forward into 2021, if we are looking at further jobs gains in terms of entertainment and the travel industry, and also with this elevated savings rate, it should continue to support consumer spending, which makes up roughly 70% of the US economy itself. Okay. Okay, and lastly, based on this chart, which I taken from Fidelity, it has shown that the global economy in terms of the different regions are starting to recover. US has actually shifted away from the recession quadrant, which is the last quadrant, as of Q4, and is currently set on a path of early economic recovery. So of course, globally, China is leading the pack in terms of economic recovery. We can look at the weekly economic index, which is an index of a total of 10 indicators of economic activities. Despite virus resurgence, in terms of a second wave and a third wave, we can see that economic conditions actually continue to improve. Why is because we know that the economy has been supported by ongoing Fed asset purchases. and of course recently with all the fiscal stimulus. So as long as there is no severe nationwide lockdown that will actually freeze the economy like what we see in Europe, actually US economic conditions may continue to improve despite all the virus resurgence. Okay, if you look at the projections for US GDP, it kind of echoed similar sentiments. So first quarter 2021 may still remain muted because of the ongoing third wave of COVID. But conditions are expected to improve from second half of the year onwards. If you look at the reading for second quarter 2021, it seems relatively high because we're actually comparing year on year. So it's actually comparing to a very low base in the second quarter 2020, where the US GDP actually took a great hit from the nationwide lockdown itself. But beyond that, we can see that third quarter and fourth quarter GDP growth it seems quite strong. Before I move on to some of the key themes that you may want to look out for, I would just like to share with you some of my potential findings on the seasonal patterns of for the US market. So it doesn't mean that we will see this pattern every year. Of course, there's no 100% kind of pattern, but this is just to give you a brief, just to give you a brief understanding of the general trend in terms of the S&P 500. So these are actually seasonality chart for the S&P 500 index, which kind of averages all years and then create a hypothetical composite of all these years, okay, to see if there is a general pattern. So what it means is that, for example, on the chart on the left, if I combine the whole year movement of S&P 500 from 2015 to 2019, okay, this will be the general trend that I get. This will be the general movement. I omitted year 2020 because it is very volatile. But if you were to add it in, you will see similar patterns. So if I extend it to 2010 to 2019, which is past 10 years, excluding year 2020, and this will be the similar trend also. So as the chart shows, during the early part of the year, the average move of the benchmark index may be relatively choppy. Okay, maybe relatively choppy. If you can see nearing end of Jan to early Feb, potentially there could be some form of retracement. And then thereafter, the market will pick up pace into second quarter of the year. If you look at this, and then from the months of November and December, based on this 10-year movement is quite strong. Okay, the index tends to deliver a strong performance. 5-year, we do not see the trend, but later I'll show you that if we extend to 15 and 20 year, actually November and December also display a very strong performance. And that is what we known as the Santa Claus rally, right? And of course, all the Black Friday trend, all these are actually based off this chart. So as mentioned, these are the chart for the 15 and 20-year time frame. So similarly, at the start of the year, it will be relatively choppy before a stronger upward move into the second quarter. So if you think about year 2021, potentially it may follow this trend. Because in terms of first quarter, we know that there is a virus resurgences, and we know that there is, a vaccination pace is of a crucial concern. And corporate earnings for this earnings season may still remain under pressure because we have all these ongoing state restriction that is still in place. So do expect a choppy quarter ahead. Okay. However, any form of retracement, I believe, will be a good opportunities for you to accumulate. Considering that vaccinations are happening and state restrictions will eventually ease. So the economic outlook may continue to improve towards the end of the year. This is just a tabulation of returns for the different months. It basically just echoed, the whatever you have seen on the chart itself. So January and February doesn't seem to have a very clear trend. More consistent months onwards will be around March or April, whereby there is kind of a stronger performance. And also November to December period, where there are high probabilities of positive returns. So with that, now I will move on to some of the key themes for year 2021. So first of all will of course be the vaccination progress. It will be crucial because it determines how fast life will actually go back to a normal. So in terms of vaccination worldwide, as of 8 Jan, there is a total of 17.3 million doses being administered across the world. So in terms of percentage terms, it translates to around just 0.2% of the world population. So in order for herd immunity to take place, we will need at least between 70 to 90% of inoculation rate. Okay, and do take note that many vaccines actually require 2 doses per person. If you think of the Pfizer and the Moderna vaccine, you actually require 2 doses for immunity to take place. So it shows that we still have a very, very long way to go in terms of vaccination progress. But of course, US have ramped up their pace of vaccination. As of 7 Jan, we have seen a total of 5.9 million doses which have been administered. And in terms of US population, it actually account for roughly 1.8%. Okay, so 1.8% of US population have actually taken their first dosage of the vaccine itself. If you look at this figure, it kind of fall well behind the 20 million inoculation that President Trump administration actually promised by the end of 2020. So currently we are just at close to 6 million. But we will expect this vaccination to be the first thing on Biden's agenda when he took office in late January, okay, which is to actually accelerate the vaccination pace. So this curve itself should continue to trend upwards. So do feel free to monitor the chart in terms of vaccination progress. In terms of a daily vaccination rate, okay, this is the number of daily doses. It has been increasing quite smoothly thus far. Dr. Fauci's statement actually predicts that US may potentially reach 50% inoculation rate by late 2Q to early Q3. So why are we looking out for this early stage? Is because if we are able to achieve this, there could be potential for US to start removing all those state restrictions that is currently in place. So we'll expect that to happen by late 2Q to early Q3, where there is, we are facing the early stage of herd immunity in the US itself. Of course, this is provided that everything kind of goes quite positively well. In terms of 2021, we will expect more vaccine-related announcement moving forward, especially from other vaccine candidates itself. For the table below, I didn't show all the vaccine players. I only include those that is currently under phase 3. If we were to be able to see a positive outcome in terms of more vaccine candidates, in terms of higher efficacy rate, or just having more availability of vaccines worldwide, it could actually further support a shift towards value stocks and cyclicals. So later I will just go through some of the value sectors that may be in play. But for now, second half 2021 may be stronger, where we will start to see easing of travel borders, and also pent up consumer demand, especially for the holiday season itself. So if nothing goes wrong, Dr. Fauci predicts that life could be back to normal for US by June. So that is his prediction. So currently in the US, there are 3 approved vaccines. We all know Pfizer, Moderna, AstraZeneca. We are looking out for the next potential upcoming contender, which will be Novavax and Johnson & Johnson. So Johnson & Johnson is expected to release their trial results soon, by February itself. So for J&J, which is Johnson & Johnson, in a way, the vaccine is not expected to have any impact financially, because J&J actually intends to sell the vaccine at cost through the pandemic itself. But ultimately, the value will come in terms of rebuilding its brand image, especially we all know Johnson & Johnson with all the lawsuits, right? But Johnson & Johnson will be more of a recovery play. Further easing of a restriction, we may start to see a rebound in terms of elective surgical procedures, which will be beneficial for its medical devices segment. So this segment actually accounts for roughly 1/3, 32% of its total revenue. And Johnson & Johnson actually is have a very, very diversified revenue stream, 250 subsidiaries worldwide. So this will actually kind of help it to withstand economic cycles more effectively. But for potential risks, will be that actually there has been ongoing global efforts to contain healthcare costs, which will actually create some form of a pricing pressure on drugs. Especially, past few days we've seen that with a blue wave, healthcare regulations may actually be easier to pass. And controlling drug prices has been actually one of the key agenda which Biden was campaigning for when he was campaigning for president. So this will actually be a key risk for his pharmaceutical arm, which takes up more than 50% of its revenue. So the next theme that we can look out for will be that despite subsequent easing of a restriction, people start to go back to work. I believe that the digital transformation in terms of the economy will continue in some areas. One of it will be in terms of digital payment adoption, which I believe will have a part to play in terms of the new normal. Some of the key growth drivers are that, firstly, with COVID-19, we have seen a surge in a user base for digital payment with e-commerce, and also a government's push for cashless payment. When we look at e-commerce, pre-COVID, the penetration rate was 11%, which means that out of all the retail sales, e-commerce takes up 11%. With COVID itself, the figure actually jumped to 14% as of Q3 2020, and projection is that it's expected to hit 24% in 2024. So it kind of means that this trend is here to stick. Okay, the whole world will start to shift towards adopting more digital payment. And secondly, if you look at the infrastructure for digital payment, many businesses have already transited to accept this kind of payment. If you look at the infrastructure, the near field communication, the NFC infrastructure that is already in place, is mostly there already. So it just means that there is a lesser barrier in encouraging people to switch to digital payment. Okay, there's less of a barrier. And with smartphone, okay, around 73% of US population already have easy access to mobile wallet, because it's kind of embedded by the smartphone makers itself. So I've got example will be in terms of Apple Pay, Google Pay, and Samsung Pay. But for all these smartphone companies itself, actually their goal of having this mobile wallet is less about generating revenue for them, but it's actually more of driving handset loyalty. Okay, and also of course data collection. So they're actually kind of collecting your data from there. So that is what they are focused on. Okay, so but for the other players, as you can see from the table, these are some of the players in the digital payment ecosystem. No matter which wallet vendors win, Visa and MasterCard may benefit, since their branded cards actually fund a majority of payment itself. So if you look at this chart back in Q3 2020, we can see that with the easing of state restrictions, in terms of the second wave of COVID, there has been a rebound in the volume of spending. If you just look from Q2 to Q3 of 2020, we have seen a particularly stronger recovery for Visa, a 15% quarter and quarter rebound compared to 10% for MasterCard. Whereas the decline from Q2 to Q1, both are relatively similar at around 10%. So for this quarter, of course, we may expect consumer spending to continue to remain weak again due to virus resurgence. But as new daily cases eventually peak towards the second half of the year, we believe that pent-up consumer demand and with the kicking in of fiscal stimulus may drive further spending moving forward. So with that, Visa may be a recovery play. It has a dominant market share of 60% in a spending network. This is as of Q3 2020. And second half, we are looking at recovery in terms of travel industry, and also consumer sentiments may actually spur greater spending. And Visa is kind of well positioned to benefit from the longer term shift to digital payment. But key risks will be that recovery from COVID will be uneven across different countries. So some countries have not even started their vaccination program yet. Okay, in terms of, for example, Australia. Okay, and Visa's cross-border business may still remain under pressure. Okay, in terms of first half 2021. So you can see the international transaction revenue was actually hit quite badly. It was down 19% in full year 2020. So the next trend in terms of digitalization will be in terms of internet advertising spending. So if you are looking at the improving economic backdrop, global advertising spend are expected to recover from 2020. In 2020, companies actually aggressively cut back on their marketing expenses, okay, in lieu of all the uncertainty. So they actually want to conserve cash. However, moving forward, based on projection from this research company, okay, budgets for global advertising spend is expected to rebound to pre-COVID level this year as economic uncertainty starts to clear, and then providing a more positive business outlook environment. And but we can see from COVID-19, internet advertising spending, okay, has gained a larger market share from the advertising industry as a whole. So more people are turning towards internet advertising. So later I'll show you which are the components. Okay, and forecast seems to suggest that this permanent shift in market share will continue to stick, okay, moving forward. So in terms of internet market share, these are some of the key components. We are looking at search engine, display, social media, and online videos. We can see from projection that social media's market share is expected to kind of increase further post-COVID, and they are poised to actually take some market share away from display advertising. So display advertising will be, when you go to a website, those things that pop up, those sidebars that you see, okay, those are display advertising. So social media are expected to gain more traction moving forward, especially with COVID. They actually see a huge base in terms of a user base. So with a huge base of a user base, you can actually market this out to all the advertisers, when they are looking out for targeted form of advertising. So I refer to some of the key trends by this social company. So they actually they interview a huge number of marketers, and then they come up with all these key trends that they project will moving forward. So one of it is that companies, they are actually facing limited budget from the recovery in terms of COVID. So with this budget, what you do is that you tend to focus on familiar favorites, because you want to make sure that every dollar you spend, okay, is more critical now. You want to make sure that every dollar you spend will be able to generate a certain form of a return on equity for you. So they interview all these marketers, and then they believe that they'll stick to familiar favorites, and then the top 5 preferred choice will be Instagram, Facebook, YouTube, LinkedIn, and Twitter. And the second trend is that companies are looking for a short-term ROI with a targeted metrics. So what this means is that, like mentioned previously, for every dollar they spend, they want to see, they want an exact figure on, what is the conversion rate? Okay, is the dollar actually well spent? So all these will actually be kind of a competitive edge of social media over traditional media. So traditional media could be like a radio or a TV. Because with social media, you can actually choose, like for example, Facebook advertising, you can choose the age group, you can choose their interest, their hobby, to see how you actually want, who you want to target. As compared to traditional media, is kind of harder to identify who is actually looking at like the TV show, for example. So this will be a competitive edge of social media moving forward. And with the huge user base that is boosted by COVID. So COVID has actually drawn a lot of user base for them. So they can actually tap on this user base to market themselves to more advertisers. So social media will be expected to gain more traction moving forward. And in terms of some of the newer, the newer players, for marketers who do not invest in a paid advertising, what they mention is that Twitter and Pinterest, they are seen as the most effective channels in terms of driving bottom of funnel conversion. So bottom of funnel conversion is kind of like the ultimate step to convert from a lead to become a client. In short, is the step of monetization. And in particular, they actually point out that Pinterest actually kind of received very, very high marks for driving bottom of funnel conversion. So we can see with this, the other time I was looking at Pinterest, with this publishing of the report, actually Pinterest has seen kind of a huge jump in terms of share price itself. So for Pinterest, currently the downside risk is that operating expenses will be expected to increase substantially because they are not focusing on profitability, they are focusing on growing their user base. So we will expect operating expenses to continue to weigh in terms of performance. But good thing is that their expansion globally has been starting to show some form of results. Global monthly active user actually increased 40% year on year in this as of second quarter 2020. And another key thing is that they actually have kind of a huge pool of capital to fund their growth plans. So you can see their cash and short-term investment is actually at around 1.65 billion. They do not have any debt. And then they actually have an undrawn 500 million of credit facilities, which they can actually tap on in the event whereby they find other growth opportunities. So the third trend will be in terms of a reopening of travel borders. Currently, US air travel are still quite weak as expected. It's currently 60 to 80% below pre-COVID level as of November 2020. So first half 2021, demand could still be low as travel restriction, I believe, may not lift so quickly. So less people can actually travel. But in terms of recovery-wise, there will be a stronger recovery in terms of domestic routes. Okay, domestic routes in terms of traveling within the country as compared to cross-border kind of travel itself. I believe many of you are looking at airlines. Yeah, so airlines near-term wise, I mean, if you are going for a short-term news play, I mean, if you are hoping that with the announcement or some form of easing of travel restrictions, I believe that short-term wise travel industry, they will see a big boost in terms of their share price. But if you are those kind of a longer term investment, probably I will recommend that you may want to probably think twice. Why? Because if you look at the chart on the left, okay, these are actually the net increase in long-term debt. of the whole airline US airline family. So we can see that COVID-19 has actually kind of changed their balance sheet really. They are actually incurring multiple folds of long-term debt. Okay, they have to incorporate all this into their balance sheet in order to survive. So their focus is actually on a near-term survival. And this debt measure, if I can refer you to the table on the right, so their leverage has actually kind of went on to be quite high. And this will likely to remain high moving forward. Why is because near term, travel industry may still continue to take a few years to recover back to pre-COVID. So with profitability, there's a lesser chance of them, trying to pay down their debt in a sense. But if you're looking for airlines, of course, the best in class in terms of debt ratio will be a Southwest airline. So you can see on the column, on the last column in terms of leverage. So they kind of have a better leverage ratio compared to other US airline itself. So the kind of the worst in class will be American airline. And that could explain, why there is a stronger recovery in stock prices for Southwest airline. Okay, but ultimately in terms of a reopening of travel borders, you can look at some of these platforms incorporated companies, okay, which owns little physical assets, okay, and they doesn't have to actually spend so much on maintaining all these airplanes or hotels kind of thing. So second half 2021, as I mentioned, leisure travel rebound should come first and should come at a faster pace. This will actually benefit Booking Holdings. Okay, Booking Holdings, because they cater more for leisure travel as compared to Expedia. Expedia will have slightly more of a corporate travel exposure, which I believe corporate travel may not recover so soon, especially with now all those easy access of having online meetings. So corporate travel may still lag for a certain period of time. And a gradual return to normalcy will of course aid ride sharing in terms of Lyft and in terms of Uber. And why I like this platform services kind of a company is because during COVID, they actually massively cut down on their fixed costs. So they are turning towards job cuts and marketing budget cuts. So they actually massively cut down on their costs in order to preserve some form of a cash to see whether they can tide through this COVID. But moving forward, this massive cut in fixed costs should actually allow for a margin expansion when things eventually normalize. So we can see from the table, that is the predicted EBITDA margin for all these platform services kind of company. So you can see that it's expected to continue to improve, okay, especially from second quarter onwards. As mentioned, one key player will be in terms of Booking Holdings. Okay, just to mention, I didn't include Airbnb here, but Airbnb also fall under this category. So Airbnb actually cut their costs also, so we should see some form of kind of a margin expansion. But due to Airbnb being quite a new company, there wasn't sufficient data to put in comparison with other players. Yeah, so for Booking Holdings, likewise, key negative will be that if you are in the online travel agent, you have to constantly compete with market share. Especially, Airbnb has come into the market, right, after getting listed. So all this advertising spending will be expected to increase in order to, they have to market themselves out in order to retain their own user base. But longer term wise, like I mentioned, massive cuts in the fixed cost may allow for margin expansion. And Booking Holdings actually has a differentiating factor from Airbnb. So its sales approach actually, they have this system that helps suppliers with excess room nights. So it's like those vacant room nights that is like, for example, tonight there's a room vacant. So they actually can promote this out to a more cost-conscious customer at a discount, okay, to mitigate this unoccupied room nights. Okay, this is compared to Airbnb because Airbnb is just straight away they let the host manage their own cost itself. So this could be one of the differentiating factors that can differentiate booking holdings from Airbnb. So the last one will of course be improving economic backdrop may continue to boost some of the laggards in 2020. First will be energy sector. I think this year may still be, we may see the energy sector kind of recover, especially with strong supply response and also post-COVID demand may be expected to aggressively draw down on global crude inventories. So near-term wise, if you are looking for a recovery play, definitely oil companies may gain traction with all the news flow. But likewise, longer term wise, we are looking at elevated leverage levels. And with such a huge debt holdings, for oil sector, I believe that they actually risk some form of credit downgrades. Okay, especially if we are talking about a longer term shift to renewables, this industry will continue to remain under pressure. You can actually start to see this in terms of Europe. If you look at their emission cap is the requirement they impose for companies. It's actually getting lower and lower every year, in line with their shift towards green energy. So all this will continue to weigh on the oil sector. Okay, probably not in 2021, but if you're looking for 2022 onwards, there's going to be some form of a problem. I put the chart on the right because that is actually the industry life cycle. So personally, my own opinion is that I believe that energy, especially the oil sector could actually be starting to shift towards the decline phase of the curve itself. But of course, if you are looking for the best in class, the one with the best debt in terms of debt ratio will be Chevron Corporation. The worst will actually be Marathon Petroleum, and followed by Phillips 66. And moving forward, as I mentioned, we are going towards clean energy, especially with a blue wave. We may see that there's a higher possibility of the 2 trillion infrastructure plan. It may be passed through, and the infrastructure plan actually focus on clean energy. And I believe that with Joe Biden's presidency, it will continue to drive some form of supportive measures in terms of regulations towards the shift towards clean energy. So it could potentially include an extension of currently they have this solar investment tax credit, whereby they are trying to encourage people to installing solar energy system into their homes. So this could benefit some of the solar companies, especially if you look at the chart below. They actually took quite a hit in 2020 with all the lockdowns and all the lockdown kind of thing. But moving forward, demand could be expected to recover quite strongly. So some of the solar companies will be Solar Edge. And of course, in terms of EV, we all know that's the most popular segment. EV wise, we could potentially see an extension of 7.5K to additional EV. So they actually proposed this regulation many years back, but it didn't pass through Congress. So potentially with a unified Congress, okay, we may be expected to see these regulations coming back again. So this will benefit GM and Ford more as compared to, I know you are thinking about Tesla. Yes, they may potentially kind of benefit. The next sector itself will be for banking sector. We know that banking sector is actually trail behind the S&P 500 in the recovery in year 2020. So this data is as of 31st December 2020. We can see that the KBW Bank Index actually trail. There's actually a huge gap between the return performance for the bank index and the S&P 500. So this KBW Bank Index is actually a index of around 20 plus of major banks. Okay, it consists of 20 plus major banks in this index. So they actually kind of trail behind the S&P 500. And moving forward, we will expect this gap to start to slowly close. My rationale is that if you look at the proportion in terms of returns between this KBW index and the S&P 500, I was looking at the recovery phase after the global financial crisis. Okay, that is roughly around 2011 all the way to 2019. The ratio between these two is you can see that it has been hovering between this range of 0.03 times to 0.04 times. Currently, as of this data is as of 31st December. I understand that these few days banks have quite a good run up. But as of 31st December, it's currently trading at 0.026 times. So I was just trying to project forward. So I raised the ratio to 0.03 times, and then I see how much upside there is actually at. And it actually suggests a potential 15% upside. And that is based on the recovery to 0.03 times. So it could potentially go much higher. So that is why I believe that, with a recovery in place, later I'll show you that they're actually quite well positioned to definitely tide through this crisis itself. So their outlook is that first quarter 2020 results may remain depressed, especially we know with virus resurgence. But I believe that long-term recovery may be in place. So we are looking at vaccine rollout that will continue to aid the service economy. So service economy will be for those restaurants, retailers, physical retailers, that kind of thing. And there will also be a potential for further fiscal stimulus in the event, especially with a blue wave itself. So Biden actually brought it up. So I believe that he may try to push forward potentially with a 2,000 form of a stimulus check as compared to currently of just 600, right? And another positive is that actually Fed they actually kept their total capital distribution. So we see that with the second stress test, they actually start to ease off. They start to tone down on the limit. So one of the key positive catalysts ahead will be in terms of the removal of a ceiling on capital distribution, and we are looking out for the next stress test, which will happen in June. And another positive is that with all these share buybacks, believe that it could provide some level of support for these banking shares, and they are able to start buying back in first quarter. Sorry, this is first quarter 2021. Yeah, not 2020. It's 2021. JP Morgan, they plan to repurchase 30 billion. So that translates to roughly 7.7% of total market cap. Whereas for Morgan Stanley, they plan to buy up to 10 billion. That will form roughly 8.1% of total market cap. So as mentioned, after the second stress test, you can actually see that banks they remain well equipped to handle this economic downturn. So this chart actually shows some of their reported CET1 ratio as compared to the minimum requirement. So for different banks, the Fed will actually assess their financial health, and then they will set a minimum requirement for these banks to adhere to by a certain deadline. And as of the second stress test, almost all the banks are able to meet this minimum requirement. Some even have a relatively, I would say, a relatively large margin, especially in the case of Morgan Stanley. Okay, Morgan Stanley. Bank of America also quite well. Wells Fargo, yes, Wells Fargo also potentially quite well. And then in order to gauge the quality of assets, if you were to look under the Fed's stress test report, so they actually have different scenarios that they predict will happen. So I was looking at the most severely adverse scenario, and then they actually have a projection of loan losses for the different banks. So industry average under the most severely adverse scenario is around 7.7%. So what this means is that if the worst comes to worst, potentially 7 to 8% of the loans may default. Okay, and some of the banks with the better quality of assets are those that actually falls below the industry average. So yes, I'm looking at Morgan Stanley. Okay, its quality of assets is relatively well, and some other players like Bank of America, Wells Fargo, JP Morgan. So all these banks, they actually kind of in a way they are in a way they are beneficial because they have this their quality of assets shows that they will be potentially having lesser loan losses as compared to the whole industry itself. Of course, I didn't put in some of the other regional banks itself, because if you are looking at those smaller state banks, of course they are not subjected to the Fed stress test, but some of the smaller state banks, their financial may be less optimistic compared to all these international major bank itself. And one concern that people actually have for banking sector will of course be the low rates, especially with Fed. They actually projected that low rate will continue until at least 2023. So this is their projection. And having low rates will be expected to keep all these banks' net interest margin suppressed. And then it will actually create a strong headwinds to banks' interest income growth. But I believe that with the recovery, we can see from 2009 to 2016, that was the recovery phase after the previous slash in Fed funds rate. Okay, so due to the previous financial crisis, okay, we actually the Fed actually slashed the Fed funds rate close to zero also. But we can see that over the years of a recovery phase, the KBW index delivers an annualized return of roughly 7%. Okay, they still deliver an annualized return of 7%, and that is actually excluding dividends. So including dividends, these returns is actually total returns are actually much higher. So we believe that having a low interest rate, yes, it may hamper their recovery, but that may not be a reason to avoid it altogether. Especially as I show in terms of the comparison of returns to the S&P, potentially the gap in returns may start to close with economic recovery. So of course, Morgan Stanley. Positive is that with Fed easing, they are actually authorized to repurchase shares. So they actually mentioned that they will try to, they actually quote roughly 8.1% of their total market cap in terms of share buyback. Okay, and moving forward, their trading business may continue its growth together with a rise in the loan balances. So in Q3 2020, this loan balances actually increased 14%. And of course, negative will be in terms of the low rates, which may continue to hurt its net interest income growth. So this negative actually applies to most banks. Whereas for Goldman Sachs will be for its business diversification. Of course, they indicate plans to resume their share repurchases. But a positive part will be that in terms of its business diversification, it may actually provide greater earning stability compared to other of its banking peers. So this may be something that you may want to look out for also. And lastly, in terms of a key risks that you all may want to look out for in this quarter, first of all, I believe we all know that there is this new strain of COVID-19, which is 70% more transmissible. But positive is that Pfizer actually, if I'm not wrong, Pfizer, they come out with a statement that says that a vaccine actually can be effective against this new strain itself. Okay, but with this spreading of new strain of COVID-19, we can see that it will further stress hospital levels. So I didn't include the chart here, but you can see that the third wave is actually, the hospitalization rate has well surpassed the second wave itself. And we have to take note that vaccination progress, it takes a minimum of 28 days. Okay, it takes a minimum of 28 days, at least for Pfizer's and Moderna. But then for incubation period for COVID, it's just 5 to 6 days on average. So if there's no containment efforts, COVID-19 will continue to spread much more quickly than how fast a person can get vaccinated. So why is this important is because we know that Biden has a very key focus on COVID efforts. So when he took office in late Jan, okay, if the COVID situation in US really goes out of hand, we may potentially see risk of more state restriction. In terms of a nationwide lockdown like Europe, we think it's less likely because him and Dr. Fauci actually believe more in public health measures. They doesn't, in a way, they disfavor another form of a nationwide lockdown because they believe that it will greatly hurt the economy. And Biden actually will look up to Dr. Fauci for advice, as previously he has done so. So I believe that nationwide lockdown will be less likely. It will be in the form of having an increasing vaccination rate, and also pushing more kind of a social distancing kind of thing. It's more of a targeted state restrictions rather than a whole economic lockdown. And second is that if you look at the margin debt, so margin debt is how much people are actually borrowing to buy into equities. It has actually increased quite tremendously from the start of the year. Why this may be crucial is because with such high margin debt is an indicator of a risk taking. So with a high risk on sentiments, it kind of indicates that investors are kind of a euphoric, especially with the COVID-19 vaccines. But once that is priced in, I believe that if the situation continues to surge, especially when we see from the curve itself is actually starting to trend up quite tremendously. I believe this could be due to the Christmas and New Year period, whereby people are more likely to meet up more, and then now all these cases are starting to show up already. So with all this, we will expect more volatile movement. But I believe that ultimately any further downside may actually present opportunities to accumulate. Okay, but do take note on this. Try not to take additional risk. Just pace out your investment, or you can just do a more kind of a dollar cost averaging kind of thing. So with that, I've come to the end of my presentation. I have 5 more minutes. Probably I'll just look at the questions. Do give me a moment. Okay, if you have any questions, feel free to type on under this Q&A. I'll be looking out for the pigeonhole also. So just bear with me for a while I access the pigeonhole. Give me a moment. Okay, let me see. Okay, for some of the individual counters itself, okay, sorry, I will not be sharing on individual counters here, but if you want, you can turn to the weekly Monday webinar, whereby we'll focus more on this. Okay, there's a question on any thoughts on the marijuana market. Yes, there has been quite a strong upward move in terms of marijuana because of a blue wave. Potentially legalization of marijuana may take place faster. that will be a longer term approach. So if you want, definitely you can start to look out for all these, but this will definitely be a very long term hold. Okay, some of the better players, I believe will be, personally, my opinion will be CGC. CGC. Okay, so I answered that. Another, will you please share your views of the US stock market? Will it continue to go higher or there will be correction? Okay, based on the seasonal pattern itself, like I mentioned, January towards end Feb, okay, roughly will be very choppy. So if we are able to see a correction, I would think that that is actually kind of a healthy form of a correction, especially with all this market exuberant. I think some form of a correction need to occur in order for a further upside move. So if we are able to see some form of correction, yes, it will be a healthy one. And then nearing the second half of the year, market should continue to trend up, especially with all those announcement of easing of state restriction, countries starting to open up their travel borders. So all this will actually spur the travel industry, which will drive a lot of consumer spending. Okay. Let me see. So I believe I with that I answered some of those questions that asking about investing in new highs of a US stock market. Okay, let me see. For energy sector, you mentioned oil will unlikely perform well. Okay, for this year, I believe it's not really. This year we are looking at some form of a rebound in terms of especially we are looking at a cut in the supply, and the economic recovery we should see a starting of a drawdown in terms of the crude oil inventory. So this year there may be some a short-term news play for the oil sector. So it's not say they are unlikely to perform well. But what I'm saying in my slide just now is that their leverage level is quite high, and their profitability levels is kind of hard to go back to a pre-COVID period. So with that, I believe that especially with all the shift towards clean energy also. Personally, I believe longer term is kind of that's my personal opinion. I believe that it's kind of like based on the industry life cycle curve, it's kind of toning towards the declining stage. Okay, if you want, you can look out for some of the emission cap from Europe. They are starting to impose stricter emission cap. So this will definitely continue lah. Yeah. I see a lot of questions on Singapore shares. Sorry, this one is a US webinar, but if you want, do feel free to post in our stocks DNB community page, and then from there our Singapore analysts will cater to it. Okay, I have 2 more minutes. One is how are the Chinese companies listed in US? How high are the chances being removed from the US listing? Okay, so there is actually 2 kind of legislation. One is in terms of, if we do know the recent news on the China Telecom. One is that if US deem that you are supporting, kind of have some form of support on with the Chinese military, so they will start to delist. That could be a higher risk for those companies identified. So they actually have published a whole string of documents on those names. So those are the one that is higher risk. But the other one whereby they are trying to clamp down in terms of accounting. So they actually give all these companies a 3-year time period for them to account and adhere to US accounting rules. So if you didn't, then they may potentially start to delete. So for that part, it's kind of a less risky, because one is that there's a sufficient time frame of 3 years. Okay, so I do not foresee it to have any huge downside impact on those companies. Yeah, the key risk one will definitely be on those that is identified. The first one that is identified to support the Chinese military. So we can see that they are actually quite kind of serious. So we may try to look out on that.